Welcome back to Griffonomics, where we conduct financial investigations to define the risk before we look at the reward. Today, we're diving into the strategic reset of Harley-Davidson, ticker HOG. We have cracked open the earnings calls, analyst reports, and internal notes to distill the core conflict facing this iconic American brand. And here is our thesis, straight up. Harley-Davidson is executing a high-stakes pivot from a premium-only model toward a pragmatic, capital-light future. The core investment opportunity lies in a massive $1.25 billion financial unlock from its financial services arm, masking the operational struggle to capture a younger, price-sensitive demographic.
That thesis, it just frames the entire story beautifully, because what we are really watching here is a massive financial reengineering maneuver. And that move is providing a lifeline, a really necessary one for an incredibly difficult operational shift.
Right. And when you look at the financials, the first thing that just jumps right off the page is this transformation of HDFS.
Harley-Davidson Financial Services.
Yeah, and this is where the money is. For decades, HDFS was the engine that sold the bikes.
Of course.
Very few people are paying cash for a $30,000 cruiser.
Exactly. But now they've done something monumental. They've partnered with two institutional heavyweights, KKR and PIMCO.
And they didn't just buy a few shares, right? This is a deep partnership.
Oh, absolutely. KKR and PIMCO each took a 4.9% common equity stake in HDFS, so it's a combined 9.8% minority stake.
Okay.
But the truly massive piece of this transaction was the outright sale of about $6 billion of existing HDFS loan receivables.
Wow, $6 billion.
It sold the debt they were holding.
So $6 billion in consumer loans, just off the books. That is a staggering transfer of risk and capital.
Yeah.
I have to ask, though, isn't selling a piece of your main cash cow, the financial arm, a bit of a sign of desperation?
It's definitely a high-stakes move, no question. But strategically, you have to admit, it's pretty genius. This lets HDFS fundamentally change its business model.
From what to what?
Historically, HDFS was what we'd call a capital-intensive lender. That means Harley was tying up billions of its own capital, its own balance sheet, to underwrite those loans.
So they were taking on all the credit risks themselves?
All of it. Their balance sheet was basically weighed down like a bank, not a manufacturer.
Got it.
Now they pivot. They move to a capital-light, de-risked model. Harley still keeps majority control, but HDFS now basically operates as a highly paid service provider.
So KKR and PIMCO put up the cash for the new loans.
They take the risk.
And Harley just acts as the servicer, like a high-margin toll booth.
That's a perfect way to put it. And the fees are fantastic for Harley.
What are we talking about?
They get a servicing fee of 1% on prime retail receivables and an even juicier 2.5% on subprime.
Wow.
So this creates a really sustainable asset-light income stream that's much less vulnerable to, the swings of the economy.
And we keep talking about this financial unlock. What does this all translate to in, hard usable cash?
The headline number is just huge. This deal is expected to generate $1.2 to $1.25 billion.
Billion with a B.
In discretionary cash. And that's by the first quarter of 2026. This cash flow is, I would say, existential.
It buys them time.
It buys them time, and it buys them resources to fund the really brutal operational changes we need to get into.
Okay, let's talk about that. How are they planning to spend this newfound war chest?
They're focused on two things: stabilizing the balance sheet and rewarding shareholders.
Okay.
First, about $450 million is earmarked directly for debt reduction at the parent company level, shoring things up.
Smart.
And second, they're accelerating their promise to shareholders. They're speeding up their plan to repurchase $1 billion in shares. They want that done by the end of 2026.
So financial maneuvers buy time, like you said.
Right.
But cash alone doesn't fix a broken product or a sales strategy. Which brings us to the changing of the guard. The new CEO, Artie Starrs. His background, frankly, sounds more like a restaurant chain guy.
He's a true outsider. Former CEO of Topgolf, executive at Pizza Hut. When you hire a retail expert, a customer experience guy, to run a legendary engineering-first company,
It tells you everything.
it tells you exactly what they think their core problem is. It's not building a better engine, it's how to sell to the modern consumer.
Does hiring a Pizza Hut guy signal a retreat from that hardcore heritage, though?
While management is trying to balance it, while Starrs brings that retail focus, they are simultaneously leaning hard into cultural restoration.
How so?
He centralized all the executive leadership back to the historic Juneau Avenue campus in Milwaukee. That's a reversal of remote work trends.
Getting everyone in the same room.
Right. And the most visible sign of that cultural push is the return of the family. Bill Davidson and Karen Davidson are back in prominent roles as brand ambassadors and special advisors to the CEO.
A move to placate the purists.
It's a crucial move. It signals they haven't forgotten the brand's DNA.
So Starr's immediate focus seems to be less about, grand vision and more about triage.
His focus is 100% on efficiency and stabilization. They're targeting $100 million in productivity savings annually through 2026.
Mostly supply chain stuff.
Mostly logistics and supply chain, but the most alarming statement, the one that really frames the desperation here, was his verdict on the dealers. He said explicitly that the dealer network is simply not making any money.
Wow. That quote is a massive indictment of the old premium-only strategy.
It is.
Harley is nothing without its independent dealers. Let's dive into that, because the sources paint a really painful picture of this crisis.
The problem isn't a lack of bikes, it's an inventory glut. And it's concentrated in the most expensive segments.
The big boys.
The touring and CVO segments. The $25,000 plus luxury bikes. Inventory there is pretty flat. Dealers can't move them.
And the macro environment, the high interest rates, turns that inventory glut into a financial catastrophe for the dealers.
That's the floor plan stress. And the numbers are staggering. Dealers were reportedly paying between $20,000 and $40,000 a month per month in interest just to hold that unsold inventory.
Think about that. A local dealership losing that much money every month just on overhead. They're on the verge of collapse.
So Starrs walked into a house on fire.
What could he even do? What immediate relief did he offer?
He offered a crucial non-cash lifeline. He put a 12-month moratorium on penalties for non-compliance with those expensive fuel facility renovations.
Oh, the mandated dealer upgrades.
Exactly, some of which cost up to $7 million. Pausing that penalty gives them immediate, critical breathing room.
That helps the cost side. But you still have to sell the bikes. What are they doing to make them more affordable for the actual buyer?
They're finally getting responsive, introducing promotions focused on affordability. So lower APR programs, especially for longer, 60 to 72-month loan terms.
So they're focused on the monthly payment, not just the sticker price.
They have to be. In today's world, the monthly payment is the real psychological barrier.
And that pivots us perfectly to the product side. Because, promotional APRs are just a temporary fix. Survival means they need new products for new riders.
Absolutely. The core challenge is the aging demographic. Their main customers are literally aging out of riding. The company has to pivot back toward accessibility and finding those magical price points.
The $10,000 bike.
And the $999 or $1,499 sweet spots, that's what breaks the barrier for younger buyers.
And the most disruptive bet here is the sub-$6,000 motorcycle. This sounds like Harley finally taking entry-level seriously.
They have no choice. This is the Sprint motorcycle. It's a small displacement bike. It's lighter, easier to handle, designed for new riders.
When is that supposed to hit?
Scheduled for the second half of 2026. This is their most serious attempt in decades to build a genuinely profitable, high-volume entry product.
Okay, that covers the bottom of the market. What about the loyalists they alienated when they killed the old Sportster?
There is very strong speculative chatter that they are listening to the traditionalists. Dealers are pushing hard for the return of a basic, air-cooled Evo Sportster-style iconic classic.
The kind of bike people think of when they hear Harley.
Exactly. And priced affordably, maybe between $10,000 and $14,000. That could be a huge win for them.
Speaking of high-tech, we have to talk about the elephant in the garage, LiveWire.
Ah, LiveWire. The electric subsidiary that was supposed to be the future.
The numbers tell a story of, struggle.
The numbers are brutal. LiveWire is in a state of strategic retrenchment. They only sold 272 units in the first 9 months of 2025. That's almost immaterial for a public company.
So what's the plan? A full withdrawal?
Not a withdrawal, but a massive refocus. They're shifting away from full-size EV cruisers and toward urban mobility.
Meaning motorcycles, scooters?
Things like the S4 Honcho and Maxi scooters. And crucially, they're targeting the dense European market with these.
And the money.
This is the biggest signal. Harley-Davidson has capped any further investment in LiveWire beyond an existing $100 million credit facility.
So they're forcing it to be self-sufficient or bust?
Basically. It's a necessary hard limit because even with the big cash injection, the core manufacturing business is facing structural decline.
Right, the HDMC.
It's the melting ice cube analogy analysts love to use, and it's brutally accurate. Harley's manufacturing margins have just eroded.
How badly?
Over the last decade, they've fallen from approximately 20% down to about 5%.
20% to 5%. That's a collapse.
And just for context, HDMC's operating margin in Q3 2025 was exactly 5%. They're pushing volume, but profitability is suffering badly.
That 5% margin is the reality being masked by the brilliant financial engineering with HDFS,
And that's before you even factor in external headwinds like tariffs.
which are a persistent headache for them.
A huge one. The company expects a $55 to $75 million impact from tariffs in 2025 alone. That volatility makes planning incredibly difficult.
And the broader industry isn't exactly helping, is it?
Not at all. U.S. motorcycle sales overall were down 7.3% in the first 3 quarters of 2025.
So the whole pie is shrinking.
The whole pie is shrinking. But, and this is the critical data point they can't ignore, accessible sport bike sales were up 71% over the last 5 years.
Wow. So the market is screaming for affordable, exciting bikes.
It's screaming for it. And Harley must tap into that trend or, frankly, face irrelevance.
Okay, let's bring this all together. The financial unlock is the safety net. The operational pivot is the transformation. It's time for the master baker analogy.
It's the perfect analogy for this strategy. For years, Harley was focused on being the master baker, only making the expensive luxury cake.
The big touring bike.
Right. Now they're realizing the immense value tied up in the high-quality flour, their financial services arm. By processing that flour, the HDFS deal, they generate the cash to fund a smaller, leaner kitchen, the motor company.
And that $1.25 billion buys them the flexibility to try and make these new, cheaper cakes, like the Sprint.
Yeah, that's it. Exactly.
So if we look at the stock, the trailing PE ratio sitting around 3.5, that looks like a screaming bargain. Is this a deep value turnaround, or is that number really misleading?
You absolutely cannot take that 3.5 PE ratio at face value. It's artificially depressed.
Why?
Because of the massive one-time gain from the HDFS transaction. When you normalize for the underlying operational earnings of the motorcycle business.
The real business.
The real business.
Yeah.
The valuation is closer to the 12 to 14 times range, which means the stock isn't cheap. It's fairly priced if they execute flawlessly.
So we circle right back to the core conflict. The ultimate question is whether that $1.25 billion financial unlock gives them enough time and capital to pull off this difficult operational pivot.
Yeah.
Before the margin erosion in the core manufacturing business becomes totally irreversible.
That is the entire investment thesis in a nutshell. Cash buys you options, but it doesn't guarantee success. If Artie Starrs and his team can launch the sub-$6,000 Sprint successfully and stabilize the dealers, they have a future. If they fail, they just used a financial windfall to slightly delay the inevitable.
Which brings us to our final provocative thought for you to mull over. Harley is attempting 2 diametrically opposed strategies at the same time. If the sub-$6,000 Sprint succeeds in bringing in younger riders, they risk significantly diluting the premium brand integrity they've fought for a century to build. But if they fail to attract those riders, the core business will just continue to age out and disappear. So which risk brand dilution or demographic collapse is the greater threat to Harley-Davidson over the next 5 years?
That is the ultimate strategic test for an iconic brand. The price of survival is always high, but sometimes the price of admission to the future is even higher.
Thank you for tuning in to this deep dive. We hope this gave you a clear and concise understanding of the complex strategic reset currently underway at Harley-Davidson.